Hi, in this section, we will deal with the issue of revaluation of assets and reassessment of liabilities at the time of admission of a partner. In this video, we will focus on why revaluation of assets and reassessments of liabilities is necessary, that the fact that there are two methods to deal with this, also when the first method is to be used and when the second method is to be used, and detailed explanation for treatment separately under method 1 and separately under method 2. So at the time of admission of a partner, all the assets are revalued and liabilities are reassessed, and any resultant gain or loss is credited or debited to partners in their old profit sharing ratio. Now, why is this necessary? The reason is because any increase or decrease in the value of assets and liabilities is for the period prior to the admission of the partner, when the old partners were managing the firm. So it should not give undue advantage or disadvantage to the incoming partner. The increase and decrease in value of assets and liabilities happened at the time when the old partners were managing the firm. There are two methods to deal with this revaluation of assets and reassessment of liabilities. We will see when each of these two methods are to be used. The first method is to be used when revised values of assets and liabilities are to be recorded in the books, which means in the reconstituted balance sheet, which is prepared after giving into effect the admission of a partner, the assets and liabilities will be recorded at their revised values. Method 2 is used when revised values of assets and liabilities are not to be recorded in the books. So in this case, in the reconstituted balance sheet which is prepared after taking into account the effect of admission of the partner, all assets and liabilities will be shown at their original values. Let's understand in detail method 1. So we said that this method is followed when the revised values of assets and liabilities are to be recorded in the books. Now in this method, any increase or decrease in the value of assets and liabilities is recorded through what is called revaluation account or profit and loss adjustment account. This revaluation account is a nominal account going by the rule debit all expenses and losses and credit all incomes and gains. So any loss is debited to the revaluation account, whereas any gain is credited to the revaluation account. A loss will result when there is a decrease in the value of asset or increase in the value of liability. And a gain will result when there is an increase in the value of asset or decrease in the value of liability. Hence, any increase in the value of liability or decrease in the value of asset will be debited to the revaluation account, and the revaluation account will be credited for any increase in the value of asset or decrease in the value of liability. We will see in detail the journal entries to be passed in this method. For all increase in the value of assets, it is asset account debit to revaluation account. For all decrease in the value of assets, it's revaluation account debit to asset account. For all increase in the value of liabilities, revaluation account debit to the liability account. For all decrease in the value of liabilities, liability account debit to revaluation. To bring an unrecorded asset into existence, it is asset account debit to revaluation account. To bring an unrecorded liability into existence, it is revaluation account debit to the liability account. Journal entry for gain on revaluation of assets and reassessment of liabilities. Revaluation account debit to old partners' capital or current account in their old profit sharing ratio. And for the loss on revaluation of assets and reassessment of liabilities, it is old partners' capital or current accounts in OPSR to revaluation account, amount being the loss on revaluation. Next, let us see the ledger accounts under this method. So this is a format of the revaluation account. The revaluation account will be debited when there is a decrease in the value of asset, when there is an increase in the value of liability, and also for bringing any unrecorded liability into existence. The revaluation account will be credited for any increase in value of asset, for any decrease in value of liability, and for bringing an unrecorded asset into existence. If the credit side is more than the debit side, it results in gain on revaluation, which has to be transferred to the old partner's capital or the current accounts in their old profit sharing ratio. So here I've assumed that the old partners are A and B, and the gain has to be transferred to these two partners in their old profit sharing ratio. On the other hand, where the debit total is greater than the credit side total, it results in a loss on revaluation, which has to be transferred to old partners' capital or current accounts in OPSR. So this is the format of the revaluation account which has to be prepared. Next, let's learn the treatment under the second method. The second method is used when the revised values of assets and liabilities are not to be shown in the reconstituted balance sheet. That is, the value of assets and liabilities should be shown at their original values. The following steps need to be taken. The first step is to ascertain whether there is a gain on revaluation of assets and reassessment of liabilities or a loss. And to get the gain or the loss, we will add the following: the increase in value of assets, the decrease in value of liabilities, and any unrecorded assets. And from these amounts, we will deduct the decrease in value of assets, increase in value of liabilities, and also any unrecorded liabilities. If the resultant answer is a positive figure, it means it's a gain on revaluation. On the other hand, if we get a negative figure, it implies that it's a loss on revaluation. The next step is to ascertain the gain or the sacrifice of each partner, we can apply the formulae old share minus new share. In the case of a positive figure, we know that the partner has sacrificed, whereas in the case of a negative figure, the partner has gained. And since this is an admission of partner chapter, the incoming partner will always gain because he never had any old share, and his gain will be equal to the share in profits which he will get on admission. Now the journal entry which needs to be passed in case there is a gain on revaluation of assets or reassessment of liabilities, we need to debit the incoming partner's capital or current account. We need to also debit any existing partner who has gained. So any other gaining partner's capital or current account. And we need to credit the sacrificing partner's capital or current account. And the amount to be debited or credited to the partner's capital or current accounts will be equal to the gain on revaluation. That is the answer to the step 1 multiplied by the share of gain or share of sacrifice of each partner. On the other hand, where there is a loss on revaluation, the journal entry to be passed will be to debit the sacrificing partner's capital or current account and to credit the incoming partner's capital or current account, and also any other existing partners who gain. So we need to credit the other gaining partner's capital or current account. The amount to be debited or credited to the partner's capital account is equal to the loss on the revaluation multiplied by the share of gain or sacrifice of each partner. So now that we've learnt the treatment under the method 1 and method 2 for revaluation of assets and reassessment of liabilities, in the upcoming video, we will solve example sums to demonstrate this concept.